Okay, we will walk through some of the formulas for the cost, volume, profit analysis. So we have our high-low method. So they give us the total costs and the units produced for 3 months. So our low is going to be the 10,000 units. So the 10,000 units, $2,400,000. And then our high point is 50,000. And then the 3,200,000. So then using our high-low method, determine our variable cost per unit and then our total fixed cost. So then our difference is the high minus the low. And then our difference here is the high minus the low. So then if we take the $800,000 divided by the 40,000 units, that will give us a price per unit. So then if we come over here and then say, okay, those 10,000 units times the $20 per unit, that would be our variable costs. And then our 50,000 units times our price per unit is our variable costs. So then if we take the total minus that, that gives us our fixed costs, and then our total minus that, you see that gives us the same fixed cost. So that, so then these are our fixed, and then these are our variable. And then what they'd like us to do is put that into a formula. So it's our total cost would be equal to our variable cost times our units plus our fixed costs. So a lot of times that's abbreviated Y equals all right, I'm not going to worry about that formula. But so that's the formula in words. So total cost is our variable cost times our units equals our fixed costs. So if we're looking for that and we want to put it into what dollar amounts we have for this particular formula, we would have the $20 times our units plus 2,200,000. That would be our formula. And then that way, once we have the formula, then we would know, okay, let's just pick any units. You know what I mean? If I sold 100,000 units, then I would put in 100,000 where that X is. So 20 times 100,000 would give me 2 million plus the 2.2 million, and then I'd have 4.2 million. So then you use that to estimate the costs at any level of production. Okay, then we go down to our contribution margin, and then our contribution margin, I like to do it in the unit when they give us that information. So we've got a selling price of $60 per unit. And then we have variable cost of $42 per unit. So then if we subtract those, we have a unit contribution margin of $18. They also asked for our contribution margin ratio. So if we had 90,000 units and we took the 90,000 times the $18 and then less our fixed cost, okay, then we sum those. That's going to give us our net income. And then this is our contribution margin. And again, now this is in dollars. So when it's in units, it's what we've got going on over here in dollars. So that if we take our net income divided by our contribution margin, is that correct? Is that given us, I did number 3. All right, so let me just double check. Let me double check my formula there. I might be going the wrong direction with that. So it is the difference between our total revenue and our variable cost divided by our total revenue. So I went the wrong direction with that. Okay, so not divided by our net income, but our contribution margin divided by our total selling price. So our total sales are the 90,000 units times that selling price. So then that divided by that gives us our contribution margin ratio. Okay. Then we covered all 3 of those. So again, this was our unit contribution margin, which was B. This is our contribution margin ratio, which was A. And then we calculated our net income from operations. Okay. Then our break-even point, we always take our fixed cost, and then we divide those by our unit contribution margin. So our fixed costs are 65,000. Our unit contribution margins or margin is the $90 minus the 35. So again, that's what we have up here, right? No, the different. So the $90 minus the $65 gives us the a contribution margin of $25. And then now we'll divide those two. So if we take the 65,000 divided by that $25 unit contribution margin, our break-even point is 2,600 units. Okay, then the break-even point if the selling price were increased to 105. So again, same formula. I'm going to copy these down, but we'll just change those numbers. So it's still our fixed cost divided by that unit contribution margin. But now if I go into, this calculation, it's not 90 minus 65. It's going to be 105 minus 65. So then our contribution margin goes up to $40. And then that changes our break-even point to 1,625 units. Because again, now we're making $15 more a unit, so we don't have to sell as many to cover our costs. Then we can have a target profit, because obviously we're in business to make money. So our target profit is going to be our fixed costs plus that target profit. Let me go back. It's going to think. Fixed costs plus target profit. And then we will merge those. Okay. And then that we're going to divide by the unit contribution margin. So then we'll fill those in. So our fixed costs are 1,800,000. Whoops. $1,800,000. And we want to have a target profit of 270,000. So then we want to have $2 million total. So to pay our fixed costs, $2,070,000 total. So to pay our fixed cost of $1.8 million plus the $270,000 profit. And then our unit contribution margin is the $50 selling price minus the $20 cost per unit. So $30 per unit. And then divide those. And we get 69,000 units. Again, our break even is the same formula that we have up here. So I'm going to copy that down because it does also ask us to do that. Then we'll change our numbers. So again, our fixed costs are 1,800,000. Our unit contribution margin is the $30 that we calculated above. So then we'd have to sell 60,000 units to break even. 69,000 for our targeted profit, 60,000 to break even. Then our sales mix and our break even analysis. We have two products. So we have AA that has a selling price of $125, variable costs of $85. Subtract those to get to the contribution margin of 40. And then we have the BB that again has a selling price of 90, variable cost of 40, so contribution margin of 50. The sales mix for products A and B is 40% to AA and then 60% to BB. So determine the break-even point in units for those. I guess for each one of them individually. Okay, so we've got our total fixed costs. So we'd have a $16 contribution margin if we're doing 40% of those. A $30 one, 60% of those. So that is $46 total. then if we come down, we'd have to sell 80,000 units total. And then if 40% of those are AA, that would give us 32,000. And then if 60% are BB, that would give us 48,000 there. And then let's just double check that. So if we come up here, make these dollars, whoops. So if we come down, I guess I'll come down below because we got space. So AA and BB, again, our unit contribution margin is $40 for AA. And if we are selling 32,000 units, and then the contribution margin for BB is 50, and we're selling 48,000 units. Multiply those out. Do the same thing here. And now let's add those two together. I have some extra decimals in there because it should be the $368,000. So where are my extra decimals at? Oh, I see them. It's in this right here, right? Yeah, this should be 368,000. Sorry, I added the extra zero there. So then that changes these ones to 3,200 and 4,800. Now we're good. Sorry about that. I thought it looked off and I couldn't figure out what I did. So I had, so this was our fixed cost, but I had an extra zero in that one. And then that is our unit contribution margin. And again, it was combined though. I calculated each one of them and then I added those together up above. So that's what that is. So sorry about that little decimal error, but then that factors that out. So then we came up with our fixed costs, divided that by our combined unit contribution margin, again, based on the percentages that each one is selling. And then that gave us our total units. Then I broke them out by the percentages that each one is selling. And then I just double checked it because again, it looked a little off. Okay, then our operating leverage, our degree of operating leverage, that's actually, I believe, what I was calculating up above on that. So that I abbreviate the DOL for a degree of operating leverage. That is going to be our contribution margin divided by our net income. So then in this one, we've got our contribution margin is 190,000. And then our income is 95,000. And then we'll divide those. And that gives us 2 times. And that's kind of how you read that. You say the degree of operating leverage is 2 times. And what we do with it is if our sales were to increase 10%, our net income is going to increase 2 times that. So then our net income would increase 20%. So that's what we use that degree of operating leverage for. Then our last computation is our margin of safety. And our margin of safety is how much extra do we have above our break-even point. So if we have sales of $36,400 and the break-even point in sales dollars is $24,024,000, determine the margin of safety as a percent of the current sales. So again, we've got sales We have our break-even point. So our sales are 36,400,000, and then our break-even point is 2,024,000, and we will subtract those to get to our margin of safety. So that's our margin of safety. And then we take our margin of safety, and then we're going to divide that number by our sales, and that is going to give us a percent. So then our margin of safety percent is 34%.